Hello and welcome. This is the third lecture video for Chapter 13, and I'm starting on page 322 of your course pack. In this lecture video, I'm going to be talking about the journal entries for issuing common stock. All right. So we have a couple different options here. We can issue par value at stock, par value stock at par. We can issue stock at a premium. And then we can also issue no par value stock and stated value stock. And so we'll talk about those journal entries and then we'll do some quick check problems, okay? So issuing par value stock at par. So issuing stock at par. So when stock is issued at par, what we're going to do is we'll record the amounts for the assets received, which is going to be cash typically. And then we'll also record the par value stock, okay? So remember stock, if we think back in terms of where stock fits into the accounting equation, stock is capital, so it's equity. So what happens, right, when we issue stock, remember we talked about this in the second lecture video. Why do we issue stock? To accumulate capital. What do you mean by capital? We mean cash for expanding operations or doing many other things. Okay, so we're trying to get cash. So when we issue stock, we get cash, and then we also increase our capital. Where do we put capital in terms of the accounting equation? That's equity. So in terms of what's going to happen with our accounting equation when we issue stock, is assets will increase because we're going to get cash, and then equity will increase because we're increasing capital. Okay? So when we look at this one over here on June 5th, Dillon Snowboards issued 30,000 shares of $10 par value stock for $300,000 cash. Let's record the transaction. So I'm going to come over here. I'll put the date, 6/5, and cash is going to go up. Cash is an asset. How do I increase an asset? You tell me. If you said debit, you're right. Remember the accounting equation? Assets equals liabilities plus equity. You know, I love this figure. Debits here, credits, debits. Okay? You remember this, and you can classify what's happening, parse this out and classify which accounts are being affected, an asset account, liability, or equity account, and then you remember this figure right here. You can do any journal entry. Okay? So, we issued 30 and we get $300,000 cash. So assets are going up. Debit to cash for $300,000. Then remember stock, that falls under equity. So our equity is also increasing. And so we show this, we say common stock, comma, $10 par value, $300,000. Okay. Now, a par value of $10, that's just what we're working with here in this example. That is not common. Okay. Par values are very, very low. Okay. Very, very low. Like, just look up Amazon's, for example. Very low dollar amount. So $10, no. But for the context of just explaining the journal entry here, we'll just assume a $10 par value. But in the real world, a lot lower. Okay. Also, issuing stock at par value is not going to be as common as issuing stock at a premium. Okay. So what this would be is when the corporation sells its stock for more than par value. Well, that would make sense, right? Because par value is going to be a very low dollar amount. And so the corporation doesn't want to only get the amount of cash equal to the par value because par value is really low. They don't want that. They want to get as much cash as they can. So they're hoping, right, that they can sell their stock above par value. That would be far more common. Okay, so that's at a premium. So let's look at this next page right over here. On September 1st, our company issues 100,000 shares at $2 par value. Our par value is a little bit lower here, but still, that's not $2 par value would not be very common. Less than $1. Okay, really low dollar amounts. Just keep that in mind. For $25 a share. So this is the market value. This is the par value. So how much cash am I going to get? Well, I'm going to be equal to my 100,000 shares times my market value. That's how much cash I get. So that's the premium. So I'm going to debit cash for my $2,500,000, which is the market value, how much I sell it for, times the number of shares. $2,500,000. And then I'll come over here is I will credit common stock $2 par value for the 100,000 times the 2, which is our 200,000. And then I also have to credit another account, another equity account. Remember, this is an equity account, so it's going up, right, with the credit. I will also credit another equity account for the difference, which is the premium, which is the difference between the market value and then the par value. And what that's called, that equity account, the name of that equity account is, it's right over here, paid in capital in excess of par value. In excess of par value, $2,300,000. Okay? So that becomes my journal entry. And again, as I was saying, this would be far more common because remember, the par value is really low dollar amount. It's below $1. And so companies don't want to just get 100,000 times 1. They don't want to just get 100,000, right? They don't want to just get the par value. They want to get above the par value because they want to get as much cash as they can because they need that cash to expand operations, introduce a new product, whatever they want to do with that cash, okay? So when you look at this figure, we have our statement of stockholders' equity appears here. So we have our stockholders' equity. We show our common stock, $2 par value, 500,000 shares authorized. Remember, that's going to, the number of shares authorized is going to be a really big number. This is the number of shares that we have issued and are outstanding that basically that our stockholders own. So that's at par value, 200,000. Paid in capital in excess of par is the difference between the market value on the date that we issued it and then the par value. That gives us our 2.3 million. And then we add in our retained earnings of 650. And remember what retained earnings is. We talked about that in the prior lecture video. That is equal to our cumulative net income and net losses less our dividends. Okay. So that's our 650, and then this is our total equity right over here, 3,150,000. Okay, so this is you can see how this is different from what we talked about back in chapter 1, where we had our statement of owner's equity. We didn't show common stock, right? We didn't show common stock there. Okay, so and we also didn't show retained earnings. And so remember, with retained earnings, we show that for a corporation, that is our cumulative net income and net losses over time, less our dividends. Okay, so far we've talked about issuing stock at par value, issuing stock at above par value at a premium. Now we're going to be talking about two more situations: issuing stock without a par value, no par value stock, and then issuing stated value stock. Okay. So when we say over here, when no par stock is issued and is not assigned a stated value, so there's no stated value assigned, that would be down here, the amount the corporation receives becomes the legal capital. That does become the par. Okay. And then is recorded as common stock. So when we look at this example, it says a corporation records its October 20th issuance of 1,000 shares of no par stock for $40 per share. So we're going to take our 1,000 times our 40, debit to cash, 40,000, 1,000 shares times the 40, and then we come over here and we say our common stock, okay, no par value, 40,000. Okay, that would be our journal entry. Let's talk about the situation where we have stated value stock. Okay, so when no par value stock is issued, like up here, but then we assign a stated value, that stated value becomes the par value. Okay, that becomes the minimum, the legal capital. Okay, so on 1020, we have our debit to cash for our 1,000 times our 40, and this is a typo. This should be 40. Sorry about that. $40 per share, and then we sell it for our $50 a share. So this is the market price. This is the stated value. Stated value is 40. Market price is 50. So we debit cash for the price that we sold it for, which is the 50 times our 1,000. So we debit cash for our 50,000 right over here. And then we credit our equity account, common stock, $40 stated value for our 40,000 right there. And then we credit our paid in capital in excess of stated value for the $10,000, which is the difference between the market price and then the stated value. Okay. The next thing that we can do, one more, is that we could issue stock for non-cash assets. Okay, we could issue stock for non-cash assets. So a corporation could receive assets other than cash. Okay, so they could receive land, for example. All right. So what we're going to do is record the assets received at the market values as of the date of the transaction. Okay, so it's going to be either recorded at the market value of the stock or of the non-cash asset, for example, land, whichever is more clearly determinable. Okay, so let's look at our example right over here. On 9/1, Matrix issued 100,000 shares of $2 par value stock for land at $2.5 million. So let's assume that we're going to record this at the value of the land, okay, which is our $2.5 million. So rather than debiting cash, we debit land because we're getting land in exchange for issuing stock. So we debit land for $2,500,000. We credit our equity account, common stock, $2 par value for 100,000 times the 2, or 200,000. And then what we have is we credit our old friend paid in capital, which is another equity account, in excess of par value for the $2,300,000. And that becomes our full journal entry. So it's similar to what we did earlier when we showed, well, let's do our issue stock at a premium, but rather than debiting cash, we debit the land. Okay? All right, so here's what I want you to do now is I want you to pause the lecture video, do this quick check problem here on 120 on page 325, and do the 2 quick check problems here on page 326, and then come back and we'll check them together, okay? Thanks so much. Hello and welcome back. So let's see how you did. With number 120 right here, a corporation sold its 14,000 shares of $10 par value at a cash price of $13 per share. So I have the full journal entry down here. We would debit cash for 182, which is the 14,000 times the market price. Credit common stock or equity account, $10 par value of 140, and then credit paid in capital in excess of par for the difference between the market price and then the par, or 42,000. So when you do the full journal entry, the answer presents itself as D as the right answer. Okay? Let's look at 121. Corporation issued 6,000 shares of its $10 par value stock in exchange for land. Has a market value of 84,000. Here's the full journal entry. Debit to land 84, credit to common stock 60,000. Okay? And then credit to our paid in capital of 24,000. And so then D is the right answer. And then finally, with number 124, the last one, C is the right answer. Debit to cash 7,000, credit common stock for the 60 times the 106,000, and then credit to paid in capital for 1,000. C is the right answer. Okay. Thanks so much. Hope you got those right.